So I'm going to cover how we can perfectly time our trades. And to start talking about that, we got to talk about our trading time frames and our strategy. And that time frame that we choose can impact our outcomes. So if you're a scalper, you might prefer a 5-minute chart. A swing trader will often use an hour chart and up. And a popular approach is actually to use the 1 hour and the 15-minute time frames. Now, the 1 hour chart is going to help you understand the broader market trend, and the 15-minute chart is great for pinpointing precise trade entries. So, for example, let's say the 1 hour chart is showing a bullish trend with higher highs and higher lows. So day traders would want to use something like a 15-minute chart to find an optimal entry point. An example of that would be when price retraces to a key support level. So we got to move on to market analysis and techniques. And analyzing candlestick patterns is great for gauging market momentum. So we want to look for shifts in buyer and seller momentum to identify potential reversals. And I'm talking patterns like a doji, a hammer, engulfing patterns. For instance, a bullish engulfing pattern on the 15-minute chart where a small red candle is then followed by a larger green candle can signal a strong buying momentum time and a potential entry point. But we always want to wait for the price to reach some key level before making a trade, because trading everywhere these occur on a chart is just a recipe for disaster. We do not want to do that. So one approach that you can do is set alerts at key levels. And this is going to save you from constantly having to monitor each chart that you're trading. So when the price approaches these levels, you're going to be notified. You bring it back up on your computer, and it's going to allow you to prepare for a potential trade. So now that brings us to the entry and exit. We want to wait for price to break a key level and want to look for confirmation of a reversal. So let's say price breaks above a resistance level and then it retests as support. Well, this retest serves as confirmation for a potential entry point. We place our stop loss and our take profit orders. Now, these are essential for managing your risk. And a common practice is to use a risk to reward ratio of 1-3. So that means that for every dollar you risk, you look to make $3 in profit. So let's say you enter a trade at $100. Your stop loss is at $95. Well, your take profit should be at least $115. And this is going to ensure that even if you lose some trades, which you're gonna, your overall profitability remains intact. And another really powerful technique for timing your trades is a momentum indicator, like the 310 oscillator. Now, momentum indicators, these just measure the rate of change in a stock's price, and they can help identify potential entry and exit points. And one effective method is to look for a hook in the momentum indicator. So if the fast line indicator hooks back up after a slight dip in price, as price retraces to a level you're looking at, it can signal a strong buying opportunity. So this technique is going to help confirm the strength of the trend, the momentum trend, and it's going to provide a better signal for entering or exiting a trade, because you can do both with that. Now, perfecting your trade exit is just as important as timing your entry, and a well-planned exit strategy can impact your overall profitability and your risk management. Here's some key techniques. First one is set clear take profit levels, especially with day trading. Establishing these clear take profit levels before you enter a trade, it's essential. So this helps you lock in profits at predetermined points. It's going to reduce the emotional aspect of trading. So you can use a risk to reward ratio, and that's a common practice. So let's say we're looking at a R to R of 1-3. So this means you risk $1, you make $3. So if your stop loss is set at 95, your take profit should be at 115. So again, this ensures that even if you're going to lose some trades, because you're going to, your overall profitability remains pretty much intact unless you've got a really horrible trading system. Trailing stop, even in day trading, when you implement a trailing stop, it can help you maximize profits during the day. It's going to protect your gains. So as price moves in your favor, just adjust your stop loss to lock in profits. So if the price moves from $100 to $110, you might move your stop loss from 95 to 105. It's going to lock in $5 profit even if the market turns around and takes you out. You can also set your stops around swing levels and trail those up, or even use an ATR trailing stop method. And you want to monitor your progress of the trade. So always monitor it and be prepared to adjust your exit strategy based on market conditions. So if the market shows signs of a reversal or increased volatility, you may want to get out of that trade early to protect your profits. If news comes out and it slams against you, well, you're not going to want to be in that trade. Avoid emotional exits. You have to stick to a predefined exit strategy and avoid making impulsive decisions based on your emotion. So emotional exits are going to lead to premature profit taking. Emotional trading is going to have you holding on to losing trades for way too long. So you have to trust your analysis and you need to follow your trading plan. But we got to talk about trade management, because trade management and consistency are key to your success long-term, period. So be patient and wait for price confirmation before entering a trade. And this is all going to be according to your strategy. You want to avoid the fear of missing out, or FOMO, because this will lead to impulsive decisions, and this will lead over time to the decimation of your trading account. It's that simple. Think about adjusting your stop losses based on the market movements. Monitor your trade progress. If that market moves in your favor, yeah, absolutely trail your stops. Lock in those profits. And let's talk about trade risk. So let's say you have a $10,000 trading account. Then you're willing to risk 1% per trade. Well, your maximum risk per trade is $100. So from there, you need to adjust your position size accordingly to ensure you do not exceed this risk. Very important. And one thing that can never be overstated is to keep a trading journal to document your trades and analyze them for patterns and mistakes that you're making. So in your journal, write down the date, the time of the trade, whatever you traded, your entry and exit points, the rationale behind the trade, and finally the outcome. And this is going to help you identify patterns and areas for improvement in your trading. You know, mastering the timing of your trades, it just involves a combination of time frame selection, a market analysis to know what kind of conditions we're trading in, a disciplined entry and exit strategy, and consistent trade management. And when you follow those techniques, you can absolutely improve your trading performance, and you can absolutely achieve consistent profitability. And you have to remember one of the key things about trading, and I learned this a long time ago, patience and discipline. These are your best friends when you're trading. And don't forget to subscribe. We'll talk to you in the next video.